So the big Fed meeting has come and gone now. Just to timestamp this for the future, we're talking about December 2016. And as expected, they raised rates 25 basis points. The market reaction was fairly normal. Right now in the pre-market, we're pretty flat. So basically no big deal. Everybody was kind of expecting this, so it's not really a problem. The only thing that I will say, though, going forward, is that because I think they waited a little bit too long to start normalizing rates, probably a couple years too long, I'm not sure I have much expectation that in the future Fed policy will be overly effective. I think a lot of people underestimate confidence in the markets, and when the Fed does such a poor job communicating their message and they get the timing of their monetary policy a little bit off, definitely a little bit late, it's hard to see that there's going to be a whole lot done when there's problems in the future. So, with very little ammunition left, obviously in 2008, 2009, you just throw a bunch of money at the problem and it was quite effective. But that's going to be off the table the next time around. So without that confidence and without that expectation that the Fed is guiding the economy, right now we are pretty much at the whim of market participants, and we'll see where that goes. I mean, right now everybody seems to be pretty exuberant about the Trump presidency and the potential for good things to come there. I'm not sure I'm as optimistic, but right now everybody's eyeing that 20,000 on the Dow and the stock markets are rising and everybody's kind of okay. But when things sort of normalize, and certainly after the presidential inauguration, we're really going to start to see where we're at. And, again, the Fed has done a pretty poor job as of the last few years. I was very supportive from about 2009 to 2013, not so much the last 3 years. So, it could spell trouble for the future. We'll just have to wait and see. But obviously, risk management and staying hedged, making sure that you're safe, not being afraid to move to cash at the right times, these are all going to be valuable going forward. So it is what it is. We're probably expecting 2 or 3 more rate hikes in 2017. Hopefully they follow through on that. I'd like to see 4, but we're probably looking at 3. And if there's no recession up until 2018, probably looking at some more there. So we'll just have to wait and see. We'll wait for the March meeting, and hopefully they do it again for another 25 points. But right now I want to get to a member question. Okay, so what would be the results of the VTS volatility strategy if we changed the cash position to an MDY, IEF, or gold position instead of the VTS balance strategy? Would it be worth it? What would be the total percent added per year? Okay, so subscribers know this already, but just in case you're coming to me on YouTube, I offer 2 strategies. One is the volatility strategy. We trade the volatility products XIV and VXX, and that strategy takes significant cash positions. So over the last several years, we've actually been in cash positions over 50% of the time. And then the other strategy is a tactical balance strategy that trades stocks, bonds, and gold with the tickers MDY, IEF, and GLD. And that one's always allocated into trades. So essentially this question is asking, what would happen if every time that volatility strategy was in cash, which is 55% of the time, what would happen if we took some of the other signals from the balance strategy, MDY, IEF, or GLD, and we took those trades instead of cash? What would be the results of that strategy? So first of all, I'll show you a chart showing basically the results here, and then I'll talk about why this is probably not a good idea to do. So the green line here is representing the strategy as it is presented. This is the volatility strategy, XIV, VXX, with 55% of the time we have been in cash, with an 80.5% annualized return. Now all I've done with the blue and the red one is substitute bonds into the cash position and gold into the cash position. And you can see the results down below. Bonds were up a little bit, up to 82.6, just simply because bonds over the last 6 years have gone up a little bit. So of course it does add a little bit to the performance. Gold, on the other hand, because 2011 to 2015, basically this whole period here, gold was down 46% during that period. So obviously it's not going to be beneficial to substitute gold into the cash positions there. But actually in both cases, it's not adding or subtracting a whole lot to the results, right? They're basically being overwhelmed by the profit that we've been making in the volatility products. I have not included MDY, which is the stock position, simply because the times that the volatility strategy is in cash, a lot of those times you'd also not want to be trading stocks because all of the signals are going to be very negative. Markets are going to be highly elevated. Volatility is going to be highly elevated. Big fear. All of those things are making us move to cash in the volatility position. You certainly wouldn't want to move to stocks during those times either. So I didn't even include it. Now, obviously, it's been a bull market the last 6 years, so MDY would have actually had a positive result as well. But there's no reason to think going forward that that would be a good idea to do. So I've just not even included it. But bonds and gold, I can see where the question is coming from. And perhaps somebody thinks that maybe you should substitute bonds or gold for those cash positions. But let me right now talk about one reason why you wouldn't want to do this. So it's my goal to have everybody who subscribes to my service eventually end up in the Total Portfolio Solution. That's the diversified fund. And of course, I understand that the volatility strategy is what catches people's eye. It's the one that has the best returns. That's the one that people are interested in the most. But as we know, it doesn't matter how good a single strategy is, you cannot put all of your money in one place. So you may be able to put 20 or 30% of your assets into a single strategy, and if it performs very well, you're going to feel those returns. But the question is, what are you going to do with the rest of your money? As we know, the grim statistics in the financial industry of how few fund managers and hedge funds and mutual funds, how few of them actually perform well, what are you going to do with the rest of your money? So that's kind of what my thought is for the Total Portfolio Solution. I want to give people a legitimate place where they can diversify their money and have it actually be diversification with a purpose, for a reason. You know, in the financial industry, sometimes diversification is more of an afterthought than anything else. They basically know that, okay, I want 50 or 60% of the money in stocks because we know that stocks perform very well over time, over long periods of time. And then, we'll do something with the rest of the money. We'll just diversify just because we have to. We can't put it all in one place. So we'll throw some in bonds, we'll throw some in gold, and that's going to save us when there's a financial crisis. Well, as we know, when there's a financial crisis, volatility goes through the roof, everybody gets scared, and correlations between assets that are usually negatively correlated can actually increase, and correlations can get very high. So what ends up happening is during a very significant crisis, when you really do need to count on that diversification and the negative correlations, it actually doesn't end up saving you because everything correlates to one and the whole thing sells off. So you end up with very significant losses. What I'm trying to do is create independent strategies, and there's 2 now, but there will be more in the future, independent strategies that all perform well on their own, but also correlate, maybe not negatively to one another, but lower correlation. So you can actually build a portfolio that has some purpose. Some of the strategies might actually perform quite well if there's a sell-off. Some of them might not. And then you do actually get that mathematical correlation that you're looking for, rather than have something that in good times appears to be a diversified portfolio, and then in bad times, everything sells off and it goes. So that's my plan. And the difference between the volatility strategy and the balance strategy, while it may not be, apparent when you look at it during a bull market, they don't actually correlate that high with one another, because volatility products and traditional assets, stocks, bonds, and gold, they actually do perform differently at different times. And they do actually have different risk profiles. Volatility products move more. So in itself, they don't pair well with one another. But they pair very well if you trade them both independently. And that's the point, is that although it's technically true that substituting bonds into the cash position of the volatility, it did actually boost the returns, those 2 products don't really pair well together. There's no reason to put them together. The traditional asset classes trade very well on their own, and the volatility classes with the cash positions trade very well on their own. And then you put them together, and it creates a very good portfolio. So let me just show you really quickly what those correlations are, and then you'll have an idea of what I'm talking about. What you're looking at here, this is my actual spreadsheet that I use to just calculate and track my returns over time and compare it to all the benchmarks. And the important parts are down here, the correlations. So you can see the first correlation I've done is to the S&P 500. Only 28% correlated to the S&P. This is very good. You don't want to be too highly correlated because, of course, stocks will at some point stop going up, and you don't want to have something that's going to crash right along with stocks. Let me just scroll over here. Hopefully this doesn't make you too dizzy. Let me find the right benchmark. Here's one. This is the VBanks, which is a very good index fund on its own. It's 60% stocks, 40% bonds. But you can see the correlation from the VBanks is 95%. So there's not going to be any protection here. When stocks go down, people should not be under any illusion. Any balanced portfolio of stocks and bonds might also take a hit when that happens. So this on its own, because it's only stocks and bonds, will also go down with the markets. Then you've got something like the HFRI Hedge Fund Index. These are basically a broad representation of hedge funds. 88% correlated to the stock market. Again, when stocks go down, people should not be under the illusion that hedge funds are somehow going to save them. They're not. Hedge funds are also going to crash right along with the stock market. So let's go back to the beginning here. This is the volatility strategy. Again, only 28% correlated. Now, it's natural that it's going to be positive, of course, because it's a bull market and both stocks and my strategies are going up. So there's going to be some positive correlation to all of these, but it's very low, right? The next correlation to hedge funds, 24%. The interesting ones, and the point of this sort of answering this question, correlation to the balanced strategy. So this is the correlation between my volatility strategy and my balanced strategy. Only 27%. Now again, it's going to be positive because both of them are going up right now. The results are positive. But this is actually a very low correlation. And this is a good thing because this is not allocation and diversification just as an afterthought. This is very mindful, purposeful diversification between two strategies that perform well on their own, but also complement each other well the other way when stocks actually are crashing and it's a financial crisis. There's a little bit of a teaser here. Yes, there will be a new strategy introduced very soon for the new year called the VTS Iron Condors. Again, it's a very good strategy, but it is low correlation to the other two strategies. So there's no reason not to add it to a portfolio. It's not like we're adding something that has an 80 or 90% correlation and we're just doing something different just for the sake of being different. We're actually adding something that does very well on its own, but also adds a great level of diversification. Because the volatility strategy, during good times, of course, you're seeing it's going up and it's doing very well. During bad times, 55% of the time it's going to be in cash. And on the extreme, on the other end, when markets are crashing, it's possible that the inverse function there actually makes us profit as well. So it's possible that it can profit during a market sell-off. The tactical balanced, while I've already said that stocks and bonds are very likely to go down, 25% of the time this portfolio will be in gold. And gold is a little bit different. Gold actually does have a significant possibility of going up during the next financial crisis. So the tactical balance strategy as well, while I would not expect it to perform extremely well during a market sell-off, it is also possible that it's profitable. And the last one, Iron Condors, this is a derivative strategy, and I'll get into it in much more detail when it's ready to launch, but it's the same thing. You would expect Iron Condors to lose money while the financial crisis is happening, maybe for the first month or two. But very shortly after that, Iron Condors during times of extreme volatility can be very profitable. So you can recover some of those early losses quite quickly. All three of my strategies are designed to be paired well together. That's kind of the point. That's what I'm trying to answer here. The VTS Tactical Volatility, the Tactical Balanced, and the soon-to-be-launched Tactical Iron Condor strategy, they all pair well together. The same cannot be said for the vast majority of fund managers and hedge funds out there that have extremely high correlations to the stock market. It's basically their fate is tied to the stock market. And I'm not that type of trader. I'm trying to get people a great rate of return during good times, and we're trying to protect the fund as much as possible during bad times. So no, bottom line is you would not want to be substituting traditional asset classes inside the tactical volatility. These are separate strategies with separate correlations and separate goals. So I would just recommend that people get into the balanced portfolio and trade all three of them individually. Allocate certain amount of money that you're comfortable with in all three of them, and don't mix up the signals between one another. So hopefully that answered the question. You can always ask me follow-up questions to this. I'm sure some things I said might have, sparked another question that you have, and I'd be more than happy to make a video to answer it. So thank you for watching, and I'll see you next time.